85% of traders get this question wrong, and it's the idea that when a point of interest, a supply or demand zone, goes on to fail, number one, why does it fail? And number two is, how does the price action look when that point of interest is about to fail on a lower time frame? Now, this is important to know because majority of traders utilize trend. As we know, the saying goes, trend is your friend. We are always taught trade with the trend, and every single trader is basically looking for where the next impulse is going to lie. Where is the direction of the market? And therefore, pretty much every trader is utilizing market structure, supply and demand area, and overall market trends. And a simplistic view, let's say, of market structure is consecutive highs and consecutive higher lows. That's going to form a bullish trend. So alongside that trend, we will have associated demand areas. There are various types of demand, but let's say the previous higher low that made the higher high, that is one of our demand areas. We know eventually when a new market trend begins, when we start to have a bearish market now, we know that all of these demand areas that were formed previously are going to fail eventually in the establishment of a new trend. So it's important to understand and recognize when points of interest are going to fail, why they're going to fail, and exactly how to identify them on a lower time frame so that we are not caught out trading the wrong direction of the market or falsely believing in points of interest when price action is showing and leaving clues on a lower time frame that this area is about to fail, and therefore we don't get caught out with unnecessary losses. Especially if you are one of those traders that just can't seem to get funded or just can't seem to hold your funded account and get a withdrawal. And specifically, if you trade market structure, supply and demand, smart money concepts, or Wyckoff theory, these four major ways of looking at the market are great. However, don't overlook invalidations, and also don't be just sworn to a theory. Understand the lower time frame so that you are more armed, more equipped, and therefore more likely to get funded. Now, first of all, let's define simple market structure. It doesn't take a genius to know the market usually goes from higher highs to higher lows, and that formulates a trend. And right here, we have a simple bullish trend of a series of higher highs and higher lows. Now, of course, it gets more advanced with internal structure, complex pullbacks, and so forth. I'll develop that in just a moment. But first of all, what are we going to be seeing? Associated with these market structure points, we'll have associated demand areas. Now, one of the forms of demand is the origination point, the higher low that went on to make a higher high. Or in a new trend, it's a lower low that went on to make a higher high. So in this case, what that means is if we had a bearish trend beforehand of series of lower highs and lower lows, when we had the last lower low in this bearish trend that went on to make a higher high relative to the previous lower high that made a lower low. I know it gets a little bit wordy, so let me do it again. Lower high, lower low. Therefore, we have a bearish impulse. When this lower low does a break of structure and does not form a lower high, but goes on to form a higher high, we have established a new trend. So that is the first demand area, and we can refer to it as the genesis demand, the origination point of a whole trend. Usually what's going to happen is this origination demand of a new trend will be reacting off a higher time frame demand area. So for example, if this is a 1 hour trend, maybe the bearish trend came to a daily demand area, and then we started a new 1 hour bullish trend from a daily demand. Hence multi-time frame analysis, multi-time frame points of interest, and therefore multi-time frame trends. And we need to therefore navigate all of these things together. So now that we've understood our initiation demand, the genesis demand to begin a new trend, then it goes on to formulate a series of higher lows and higher highs. And all of these bullish impulses inside from higher low to higher high, these are going to leave demand areas. But there's also other types of demand. There's also weak supplies. There's also false supplies. So for example, our weak supplies are going to be valid supply zones. There are areas that formed a new lower low, and there'll usually be a lower high that went on to make a lower low. By definition, that's a supply zone. However, when a new trend has been formed, a new impactful trend, for example, a higher time frame daily demand area, therefore this is not a retracement to make a new lower low. This is actually a new bullish trend being formed. Therefore, all these supply areas become counter trend in nature. Even though they are supply zones, they are weak supply zones. So therefore, in any trend, you're going to have the pro-trend POIs, in this case is these demand areas, and you're going to have your counter-trend POIs, and these will be these weak supply points. So now we are starting to build a bit more confirmations on directional bias with points of interest. And when we go deeper, we can start to realize inside of all of these impulses, the higher lows that made the higher highs, for example, there's going to be internal price action. So for example, if this is the 1 hour, we know on a lower time frame, this is going to have a series of higher lows and higher highs within there. So for example, over here, this is part of the bullish trend, let's say. We have this area that led to a higher high, a higher low that made a higher high. Now, when we have this area, we know that it's going to be a demand area, and that's going to be our extreme demand. That's the origination point of a move, of an impulse. And therefore, we outline that as a demand area. So now looking into the internal price action, we can see we have a series of higher lows and higher highs. Now, not all of these will be relevant, but there will be certain ones in the formation of the main impulse on a higher time frame. We have the internal higher lows and higher highs. So therefore, we have internal demand areas, but not every single one of these internal demand areas are relevant. And therefore, how do we decide which ones are going to be POIs and demand areas that should be respected in the future versus just areas of interest that could have a false reaction from? And this is where we have to look into intent, and that will be the law of cause and effect. So the way to identify this is through a cause, which is if we have a lower time frame inducement inside of the POI, that would be wonderful. Or usually more importantly, if it leads to a move with intent, if it leads to a structural break. For example, this is a ceiling in price right now. Price could not break this level, and we started to have the retracement from here. So eventually, these buyers over here, this level where the buyers entered the market, had enough force to not only break the previous ceiling, but also break this major ceiling, the previous higher high. Therefore, the buyers were able to break this zone, and therefore this is an intentful zone, the law of cause and effect. So therefore, we re-examine these demand areas to say, did it lead to a break of structure? If it did, it is more relevant. Or if we are to examine on a lower time frame and say, what happened in this area? And we come into this area and we start to see price not only did lower lows and lower highs and then higher lows and higher highs, just a simple bearish to bullish price action, bearish to bullish price action. Instead of that regular formation, if we start to see bearish price action coming in, consolidation of some form, an inducement low, a strong push out, and then price flies from there. So basically a build up, inducement, mitigation, leaving large imbalances, leaving bullish momentum, fast aggressive price action with internal breaks of structure and potentially follow through minor inducements. This is again a very powerful sign. So what we will start to do is pair intentful moves, therefore breaks of structure, not of immediate price action, but of previous price action, and also the internal price action of the demand area if it has a liquidity cycle within there, if it has a medium or minor inducement in there, then these are going to be wonderful demand areas. And this kind of price action is going to be happening in every single market movement, whether it's pro trend, whether it's old trend, whether it's weak supply points, strong demand areas, and vice versa. All of these considerations are going to come in. So now imagine we have price action looking something like this, where let's say 1 month ago we had this bullish trend forming, and then this week we have this bearish trend. So I'm just drawing out an example. So we know historically from let's say 1 month ago, this is a higher time frame demand area. This area was the genesis demand of a bullish trend, and then some weeks passed and then we have this bearish trend and channel forming. So when we mark out these relevant points, we have a series of higher lows and higher highs, and therefore we know that a bullish trend ensued from this genesis demand. So now we know that is a demand area that price, if it comes back to, could be respected. So we have these last higher lows and higher highs of a previous bullish trend. And then eventually we come to the final high in the market. That final higher high in the market leads to a lower low. Now remember, the two ways I said we should identify points of interest should be if it's a new trend, therefore genesis points of interest are going to be higher highs that form a lower low, or a lower low that forms a higher high, a break in structure and a new trend. Once we have identified that new trend where we've had a higher high that forms a lower low, then we see the consecutive lower highs and lower lows, and therefore every single lower high that goes on to form a lower low will be supply. So we have the last higher high and every single lower low will be a supply area and therefore a potential point of interest. Then we also have to understand what is a meaningful supply area, what is a pro-trend supply area, and what is a weak supply that could just be liquidity, and therefore we need to navigate that. Next, we'll have the zone of indecision, where this is a potential lower high that it should go on to make a lower low, just like the previous ones did. However, this one, this last lower high, does not form a lower low. It forms a higher low. And if this area goes on to form a higher high, therefore we can say the trend has shifted, this supply zone failed, and therefore we will have a new genesis demand that led to a break of structure to take out a previous lower high that made a lower low to form a higher high. And therefore, we will have two demand areas. One, which is the genesis demand, the extreme, the one that initiated the break of structure of the new trend. And the second one is going to be the decisional, the one that immediately led to the break of structure. Now, we had all of these previous supply zones. There's genesis supply right here that initiated the bearish market. And we'll also have all of the associated supply areas that led to lower lows in this bearish trend, where we have the initiation genesis supply and then all of the previous lower highs that form lower lows in that bearish channel. Now, a lot of traders might get caught up and say, oh, this is a supply area, it led to a lower low, therefore we should look to sell. And maybe that is valid because we need to understand what is the power of this previous demand. Is it an impactful and significant one that is going to simply fuel the retracement to form a new lower low, or if this is going to be the main trend? So now we are in decision. Is this bullish price action that is starting part of a retracement, a bullish retracement, or is it part of a bullish trend? And therefore we need to understand what is the intentful move, because if we identify this as a retracement, we know that we should be looking for sells in these areas. However, if we identify this as the new bullish trend, then we should be looking for buys. So it's very important to understand meaningful trend. Despite points of interest, despite saying this is a demand area, this is a supply area on a higher time frame, both of them are. What is the real trend? So how can we identify that when the daily might be bullish, the 4 hour might be bearish, the 1 hour might be bearish, the M30 might be bullish, the M15 is bullish, and the 5 minute is bearish? When you have all of these mixed time frames, mixed POIs, market structure can get overwhelming. And even if you truly understand market structure and supply and demand to its entirety, there is still weaknesses. There are still points where market structure is not enough to give a conclusive answer, because you'll be in a zone of indecision. Just like here, we had a zone of indecision. When price comes to this final supply area, we are in indecision because we know we have come to a higher time frame supply, and therefore are we going to get a new bearish market from here? And therefore this would be the movement where we have retracement, continuation lower. Or is it going to be more the case of it's a bullish trend that is forming because we came off a higher time frame demand, we have internal bullish price action, and we might have a bearish reaction from here, but we should expect price action to go on to make a higher high. This is the decision to make. And how can you know which supply or demand area is more valid, which higher time frame trend is more valid? And it usually falls into speculation. Maybe some people will support that with fundamental analysis, and that is actually great. Or you can just simply understand internal price action, internal liquidity, daily cycle, liquidity cycle, and structure cycle to reveal the real intentions and know which one is the false move, which one is the false trend, and which one is the real trend. This is going to significantly improve your trading because you're not only relying on market structure and points of interest. So let's get into that a little bit more. Now, as we look at this a little bit further, we can see that we've had this bullish price action. We are yet to determine if this is a retracement and therefore a complex pullback or the new bullish impulse. So how do we start to identify and get more details within this? So first things we will do is mark out the associated demands. For example, this area is a higher low that made a higher high. So we know that that is a demand area, but there is more information within here where we can say this trend line that was building led to this inducement, and that inducement led to a new higher high internally. We can see we had the buildup of liquidity, inducement and run of liquidity, mitigating the previous demand, leading to a new higher high. So therefore we have established a new demand area. This one is intentful because it had an inducement within it. We also identify within there, we have the decisional demand over here that led to the new higher high, the specific one that led to the new higher high. So sometimes you get zones that overlap and therefore you have larger zones. Sometimes there are independent zones. There's all these complexities that you need to be aware of. And then we have, once again, a buildup of a trend line. And we also have the demand area here that led to the higher high, not forgetting the fact we had an inducement within there. So we had a buildup, inducement, new higher high. And then we see price continues on to form decisionals, the ones that break the structure of this previous lower high that made a lower low. And we are just continuing this bullish trend. When we mark out our bullish structure points, higher lows and higher highs, like so. It's a very simple market structure, and this is something everybody knows. And then we also have the internal structure, which is going to be internal higher highs and higher lows, and internal lower lows and lower highs. So we have mixed trends within, internal lower high, internal higher low, new break, higher high, and we have all of this internal price action to navigate. But that's the read from the bullish trend. That's the read from the bullish perspective. But we also have the counter narrative, which is the bearish perspective, and that bearish perspective, which is going to be led by this genesis supply on a higher time frame that led to this bearish trend. Let's say this is now a retracement. We need to know where it's going to react from. Is it going to be a retracement to this supply, this one, this one, this one, whatever it may be? So one indication could be we have a break of structure over here. So therefore, we can say this is the genesis supply. However, the decisional supply, the supply zone that led to the break of structure is this one right here. So therefore, we say we can have all of our supply zones, but then we have our significant supply and our significant supply. And therefore, these ones become intermediate supplies or weak supplies once we come to a demand area. Now, when we see that price comes into this preferred supply area because it led to the break of structure, not only a lower high that formed a lower low, it also took out a previous higher low that made a higher high. So therefore, it's structurally impactful. When we see price arrive over here, we can see, oh, we have a buildup of liquidity. We have a run of liquidity mitigating our supply zone and leading to a bearish break of structure and a lower low. So therefore, people will be looking to sell here. They'll say, oh, we've had a meaningful supply, we've had a buildup of liquidity, we've had an inducement, we've had a break of structure, we've had a lower low form, and we identify a new supply area. So therefore, a lot of sellers will be in there and a lot of liquidity will be in this area based on that structural price action. But why does that go on to fail? Well, we could say, oh, the reason is because this bullish trend was too powerful. And we could say, oh, this build-up inducement was the fuel to break past there, which is again true. But we have to realize what is hindsight justifications versus actually understanding price action. Let me say that again because it's important. What is hindsight justifications versus truly understanding price action? So hindsight justification, if it was a sell, let's say the market went lower from here, we would say, oh yeah, makes sense. We had a build-up, we had a run of liquidity, we tapped into this supply area, we had a break of structure, of course it made a lower low. That is hindsight justification. Or if price goes on to make a higher high instead of a lower low, the hindsight justification is, well, yeah, we had this build up, we have this inducement run of liquidity, and we have this new higher high, obviously because we had all of these previous high highs and higher lows, all of these previous inducements, demand areas. Once again, hindsight justification. So how do we stop doing hindsight justifications and actually understand the reality? Well, looking at this from a higher time frame alone, you will be stuck in just reading what you see. But if you jump down to the lower time frame, that's when you start to really understand what we see. So let's actually do that activity. So now if we are to focus on this price action over here, the one that was a supply area that was valid, that was a significant one because it led to a break of structure of a bearish trend and then gave a bearish reaction based on this build-up, inducement, break of structure, went on to fail. So we have to understand, not through hindsight justification, but actually what happened. So let's start to draw this out. Okay, so now we've zoomed into this supply area. We can start to see we had that build-up, the one that was right here. Then we had the final inducement, tapping into the extreme of the supply area, and then we eventually have the break of structure. So that is the bearish perspective. The bullish perspective can be this trend line that is forming. We have an inducement of this, and then eventually internal price action goes on to do a higher high, like it did over here. From this inducement low to the new higher high, we had the inducement low to form a new higher high. So these are the price action signatures, but there is more detail within here that we need to spot. And that's going to be starting to understand what is a build-up and inducement versus a smart money trap. So let's say this area that looks like a smart money zone is actually a trap. And the reason for that is we need our invalidations. Number one is the liquidity pool of that trend line. Okay, well, that's something, but that's not the be all and end all. It is another factor, which is this demand area that prices come into. Now, is it important that price came into this demand area over here, this previous higher low that made the higher high? Is that important? Well, we have to investigate what happened in this zone. This area over here that led to the higher high, why is this one being respected and not breaking? And the reason for that is on a lower time frame, what do we see over here? We'll have price action going bearish, and then instead of just doing a bullish break of structure, we might get an accumulation like so, where we have the selling climax, secondary test, spring test, and this overall being an accumulation schematic. Or in other words, we have a buildup of liquidity, an inducement, and a push out. So therefore, we need to see an inducement within there, whether it's a minor inducement like this, or it can be a medium inducement, for example, of Asia range in a London open window, or it can be a structured inducement, maybe even a major inducement. Whatever the inducement type may be, we need to see it's not regular price action, rather we've identified an inducement within that demand area. Once we see that this is an inducement demand area and then price is coming into it, we don't automatically say, oh, it's an inducement demand, it has to respect. We see the nature of price action coming in on a lower time frame here. So for example, if this is coming in the key time window, in a London or New York key time window, or in our trap moments, for example, Frankfurt Open or New York Open, and we see the same thing once again. On a lower time frame, we are getting a build up, we are getting a run of liquidity and a push out, let's say, and then prices come in like this. We know that this could be a signature on a New York Open, for example, of a smart money trap. And remember, you need to know your qualification criteria for smart money traps, and then you get the false smart money trap reaction, real inducement, push out. When you see something like this with the smart money trap, real inducement, you'll see this all the time, by the way, and then the real reaction. You know that, okay, if we've had this build up and inducement off a higher time frame, structurally relevant supply zone, that is reasons to get in the trade, of course. But then if you have an inducement in this demand, then you have this build up of a trend line and this inducement that's happening of that trend line. And then on the lower time frame, you are getting this kind of smart money trap formation. You can start to say who's in control. Is it going to be this inducement alone, or is it going to be the inducement here, and the inducement here? And then if you are still unsure, timing will help you. So for example, if you know you have your New York Open here, this is your New York Open, and price starts to react and is doing this build up like this, and then price is coming lower, inducing this trend line, and we are within our New York key window, and we are sitting over here. That New York key window is going to tell us that is over here, that this is more likely to be pushing higher and therefore breaking this smart money trap level. Whereas if our key window price is sitting over here, it gives us more inclination to respect or do a medium inducement and then respect. So timing is going to be crucial too. Both M1 inducements and liquidity and price action, in addition to time, will guide you. We don't have to sit and guess and say which area is going to respect, which one's more powerful. Do we now do the higher time frame trend, lower time frame trend? This is one layer of thinking, and it does work a lot of the time. And that's why a lot of smart money traders, market structure and supply and demand traders make profit. But to understand their losses, you have to understand this. To see, okay, what are the early signs of point of interest will fail? It's going to be time-based manipulation. It's going to be inducement within the previous bullish trend, inducement upon those areas, time window, and other factors to identify smart money traps. And eventually you'll start to see points of interest respect or fail. The signatures are going to be there on the M1 timeframe. So that is one way for us to identify failing points of interest. There is multiple ways to start to understand in-depth price action that goes beyond just market structure and supply and demand, but rather understanding the complexities of supply and demand, the complexities of market structure, and then adding on manipulation, time, traps, inducement, all of these things. They all go hand in hand because they synergistically create ideas, and this is the holistic view you need to have. Now, other categories, if you'd like me to cover, just let me know in the comment section. For example, starting to understand the complexities of these trends, understanding clearly how points of interest are valid and more valid versus weak and invalid. You need to have that full criteria that is going to be checklisted and mechanical to therefore have a spectrum to say, I'm coming into a low probability zone, a medium probability zone, a good probability, or a very high probability. And you need that spectrum. Additionally, you need your markers of the day from the time of day to know how that increases or decreases probability of real moves versus traps. And then you need to understand real inducements versus smart money traps. And therefore, when you start to piece all these things together, that's why you'll understand that these restrictions, these confirmations, these checklists that I have of confirmation types and invalidation types, when you connect them all together, you will start to understand that a restricted trader is a profitable trader.